Generally, in order for us to understand the client entity, set materiality level, assess the risks of material misstatement and all this, we're going to be carrying out audit procedures. Now, I'm going to explain audit procedures to you pretty later on in our discussion, but it is the 5 vowel sounds. The 5 vowel sounds. You did this in KG2 when you were taught vowels, consonants, and those things. So when we talk about audit procedures, we mean the 5 vowel sounds. I'm going to explain them to you a little bit here, but we'll talk about them later on because I want us to contextualize our discussion a little bit here to find out whether you guys can come up with some of the procedures we will undertake. Okay, so stay with me very carefully. So audit procedures. The 5 vowel sounds. A means analytical procedures. Now, what is analytical procedures? In a simple language, analytical procedures refers to the comparison of information. Okay? The comparison of information to identify patterns, trends, or changes. That is analytical procedures. Please stay with me very carefully here. So what does that mean? When we go to the company, and for instance, we are dealing with closing inventories, and we are carrying out audit procedures on closing inventories, the first thing we may want to do is to look at analytical procedures. So let's say we are doing closing inventory. We will look at analytical procedure. What does that mean? We compare. What do we compare? We will compare, for instance, last year's closing inventories with the current year closing inventory and the budget of the company closing inventory, so that we will identify some trends, some changes, and build our knowledge up. So for instance, if last year the closing inventory of the company was $10,000, but this year the entity says their closing inventory is $24,000. But as per their budget, that is the budgeted statement of financial position, they said they will record a closing inventory of $15,000. That is what we mean by analytical procedures. Comparing data. You compare the current financial statements with the previous year financial statements with the budget of the company. Sometimes you can compare the entity's financial statements with the industry average, or compare the financial statement of the company with another company. That is called analytical procedures. Everybody good on that? We are comparing. Now, if you look at a glance what I have here, last year it was 10,000. This year it is 24,000. In the budget, management said they expect to have closing inventory of 15,000. The question is, why has the inventory gone up from the last year by a little over 150%? And then from the budget, why has it gone up a little over maybe 70%? It will be less than that. Why? That leads us to the second procedure called inquiry. So E is for inquiry. Now, let me say this before I jump over. That doesn't mean each audit procedure will follow the order like this. Because there are certain things when you are carrying out audit procedures, we won't do comparison. So it doesn't mean every audit procedure will follow this, but you just have to know how they are connected. That's why I'm explaining them. So E, enquiry. 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 So what is enquiry? It refers to the request of information further information about an assertion. Please note that in audit, when we say assertion, we mean statements made by management. So the sales figure in the P&L account is an assertion. The operating expenses is an assertion. Trade receivable figure is an assertion. Trade payable is an assertion. So when we say assertion here, we simply mean, in a simple language, a figure in the financial statements or a statement made by management in the notes to the financial statement. We are seeking further information. Please note, it depends on the audit, the item being audited, but inquiry can be made internally or from external source. So internally, we can make inquiry from employees. We can make inquiry from the management. We can make inquiry from those charged with governance. Internally. So for instance, we did the analytical procedure. We realized that is. Now remember, if closing inventory is 24,000, if closing inventory is overstated, we've mentioned that profit will go up, GRA will come down because asset will go up. So now we will have a questioning man. Then we'll go and ask management, why is your current year closing inventory up by 150% from last year and up by 70% from your budget? Why? That is called inquiry. So we ask management why. So management will then give us written representation. Remember, we spoke about this. I told you that when the auditor is asking management a question, the auditor will issue what we call management letter. When management is responding, management must put their response in writing, and that is called written representation. So now management will write to us the reason why the inventory has gone up by 150% from last year and 70% from the budget. But when they explain to us, sometimes we need to go outside the company for further information. So externally, we may need to make some inquiry as well. Explanation. So externally, we need to make some confirmation. So sometimes we will need external confirmation. External confirmation about what? From the banks of the company, about loans, okay, about bank balances. We need information about that. Loans, bank balances, so that we can prepare the bank reconciliation statements. So if we are auditing loans, we are auditing bank balances, we are dealing with bank reconciliation statements, we need a confirmation from the bank. So we have to speak to the bank. Not only that, sometimes we have to speak with, debtors about their debts outstanding. Sometimes we got to speak with creditors about how much we owe them as a company. And sometimes we have to speak with other related parties, if there is any, or maybe, clients, other clients of the company, or customers of the company. That is the idea about inquiry. Are we following the picture well? So you did analytical procedures. Inventory has gone up. You asked management, and management said, oh, close to the year end, our suppliers were doing a promotion, so we had to buy in bulk to enjoy some quantity discounts. That is why the inventory has gone up than we had budgeted for, because now with the Ukraine and Russia war, it's a good advantage for us to buy the inventory and store it. Okay, that's what management said. Is it true? We have to find out. So one way you find out is go and speak with the creditors. External confirmation. So we speak with the creditors and say, hey, did you guys do any promotion like that? Why did you supply goods to the year end plenty like that? Now, we could go deeper than that, but we ask about them, about what management is telling us. And remember, external confirmation is more weightier than what management tells us internally. That is one of the qualities of audit evidence, and we'll look at that pretty later on in our discussion. But that is the second thing, inquiry. So you compare data to check pattern, to check trend, to check changes, but then you have to also make inquiries, either internally or externally. Okay. But after inquiry, sometimes we got to do some inspection. That is the third vowel sound, inspection. 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 So what is inspection generally? It's inspection. You know, it's go and ask your English teacher. Inspection refers to the simply verification of certain items. Okay? So investigation to verify, an investigation to verify certain items. So that is inspection to verify certain management assertions. Now, we can inspect contracts that a company has entered into. We can inspect title deeds to determine the ownership of the company's assets. We can inspect other documents of the company. So that is inspection. That is inspection. Once we inspect, we need to go to see whether things are done in a manner that is supposed to be done. And that is O for observation. That is O for observation. Observation is where the auditor tries to see whether internal controls are working in a manner that is expected to work. So it refers to the assessment of the efficiency of internal controls. That is observation. That is observation. So sometimes observation may come in, for instance, we attending inventory counts. So at the end of the year, we are attending an inventory count. We will observe to see how it is done. Because maybe in the entities manual, they have stated that, oh, when we are doing inventory counts, we do A, B, C, D. So we want to see, are they counting the inventory well in a manner that is supposed to be counted? Sometimes we would have to also check the efficiency of the accounting systems. So the accounting systems. If you are looking at the efficiency of the accounting systems, we're going to use what we call dummy transactions. Dummy transactions. This is what I was talking to you about last week when I drew this diagram. This diagram. So you go to the company and the company says, if someone places an order, this is the stages it goes through. Observation means we put in a dummy transaction to see if it will go through all the stages. Last week, I told you about this when we're discussing the internal controls. When we're discussing the internal controls, if you remember last week, I told you about this. It's called observation. So you put a dummy transaction to see if it will go through the stages as stated by the management of the company. That is what we mean by observation. Observation. Then the last one is recalculation and reperformance. So the U is recalculation and reperformance. The recalculation is to determine the arithmetic accuracy of the figures. So for instance, recalculating the depreciation of the company, that is recalculation. So sometimes we have to do the calculation ourselves, or impairment to see how much impairment they are supposed to charge. It's recalculation. Or anything, revaluation of assets. Let's calculate it and see how the revaluation surplus or revaluation loss was treated. Accuracy, recalculation. The tax is very important. So the tax figure that has been recognized in the P&L account, is that the amount that is supposed to be recognized? Recalculation. So it depends on what we are auditing and the kind of procedures that we're going to carry out. Reperformance, on the other hand, is where we try to prepare our financial statement to see if it will be in line with the figures that the entity has. So it is redrafting the financial statements. So because as auditors, we have to also prepare our financial statements when we come, so that we can compare our financial statement based on our calculation with what the management or the company has done. So that if it is not the same, then we will let management do the necessary changes. If they refuse, then we may decide to modify our audit report or not. Any questions? These are the things we must understand when we talk about audit procedures. So
yeah, Nhyira.
Yes, ma.
Thank you very much for the audit procedure. I really enjoyed it. But I don't know whether the vowels are standardized acronyms or something that you developed yourself.
No, they are available generally. That can be used, the AEIOU. They are available generally, but that is the way I like to put them up.
Okay, I was trying to have a thought that if you can use the word understanding, with the understanding that, or the meaning that if you want to understand, you as the auditor, you do the recalculation or reperform yourself. Understand.
Okay. Yes.
To understand.
Yes, that could be, that will also be a valid discussion there. That will be a valid, but so that the you will be, if you want to understand what has been done, then you calculate and reperform.
Perform it yourself, true. Yes.
That's very true.
All right, thank you very much.
Okay.
Thank you.
Okay. Now, that does not mean that when the examiner asks you about audit procedure, you write 3 points or 4 points and you go away. Because you see, we can make inquiry from various people about a certain item we are auditing.